Welcome to the Savvy Commercial Real Estate Podcast, your resource for relevant, helpful, and immediately usable information regarding all things commercial real estate. Whether you are buying, selling, financing, exchanging, managing, or developing commercial real estate, rest assured you are in the right place. Savvy Commercial. Listen, apply, repeat.
And good morning, everyone, and welcome to the Savvy Commercial Real Estate Podcast. My guests today are Brandon Hughes of Asset Preservation, Inc., and Brian Lang of Inland Securities Corporation. Brandon Hughes is a division manager with Asset Preservation, Inc., a wholly owned subsidiary of Stewart Title and Trust, one of the largest title insurers in the country. Prior to joining Asset Preservation, Brandon worked as an accounting professional for one of the world's largest professional service firms, Ernst & Young. During his career, he has worked with many real estate agents from the commercial and residential sectors, as well as commercial bankers, commercial brokers, mortgage brokers, financial advisors, and DST affiliates. He also has an extensive background in IRC, 1031 tax-deferred exchanges, and every aspect of real estate transactions. Brian Lang is the Senior Vice President for Inland Securities Corporation, having joined Inland in 2015. Brian is responsible for education as well as raising capital for Inland's tax-deferred and private equity real estate solutions, covering Arizona, Colorado, New Mexico, Utah, and Wyoming. Prior to joining Inland, Brian was a Senior Vice President with Cole Capital from 2010 to 2015. He holds a bachelor's degree in economics from the University of Arizona, along with his Series 6, 7, 63, and 65 securities licenses. He currently resides in Scottsdale, Arizona with his family. Today our focus will be on Delaware statutory trusts, commonly referred to as a DST, and more specifically what they are exactly, how they work, who should invest in them, and how investing in a DST can actually fulfill the IRS requirements for a tax-deferred 1031 exchange. Good morning, gentlemen. Let's jump right in here. Brandon, can you give us a quick rundown of how a basic 1031 exchange works so we can set the table, so to speak, for a discussion about DSTs?
Yeah, thank you, Neil, definitely. And I know that we're going to be DST specific or focused today, so if you need to, I'm going to try and keep it high level, I'll say, but then if you need to ask additional questions, have me elaborate, happy to do so. But before going into the basic rules and regs of a 1031, how it's done, I think it's important to take a step back and say, well, hey, why do we do an exchange? And Neil, you can probably point to this, so you see it every day, but what happens when you hold real estate for more than, sometimes a week or a few months? I mean, it becomes more appreciates, right?
Sure.
So yeah, we have appreciated real estate, appreciated real property. And a lot of people, they think, well, hey, we're going to have some federal capital gains that are put on this. It might not be too bad, say 15%. But in actuality, when you sell appreciated real property, you could be hit with potentially 4 different levels of taxation, right? So we got our federal rate, could be 15%, could be 20%. You got your state rate, varies by state. Arizona could be around 4.8, maybe 5%. Higher if you're in other states, right? We got California with 13.3%. There's also depreciation recapture. A lot of people don't think about that. But you get that benefit of depreciation every year, and then the IRS comes back and they tax it at 25%. Lastly, we have the net investment tax, the NIT. It's a surtax, 3.8%, so not too bad, but still could come into play. It could still factor in on top of everything else you have.
Thank you, Brandon. I appreciate that. Brian, can you explain to our listeners why exactly this is called a Delaware statutory trust versus, for example, a Florida statutory trust or some other statutory trust? And also, if you could add to that, what are the obvious advantages to someone investing in a DST as opposed to, say, going it alone if that's what they've always been used to doing?
Yeah, absolutely. And thanks for having me on, Neil. Delaware is actually one of the few states in the U.S. that has statutory trust laws. Most states actually rely on common law trusts. Interestingly, even though common law trusts are still used, they have a lot of just outdated rules, which can really create a lot of uncertainty about a number of legal aspects and trusts themselves. Delaware has actually undertaken the task of modernizing the common law and creating an effective secure form of the trust entity itself. So kind of on the cutting edge of just really structuring something that has a lot less ambiguity involved. As far as some of the benefits, why somebody would look at doing a DST, I think a number of different reasons. By and large, where many investors consider this structure are those that, as Brandon mentioned, have highly appreciated assets, but maybe they're just at a point in their life where they're tired of being a landlord. I'm tired of getting the calls on Christmas Day and New Year's Eve that toilets are leaking, roofs need to be repaired. Like I said, I've got this highly appreciated asset that I want to sell, but I don't want to get hammered with the tax side of things. So what do I do? The DST is actually, I think, a pretty unique vehicle that really can pass along a lot of the same benefits that many individuals have owning real estate on their own, but they're just doing it in more of a passive manner. Got it.
And staying with you for now, Brian, are there certain asset classes or property types that work better with a DST than others? And if so, what are those exactly?
Yeah, good question. We do see a wide variety of different asset classes inside of the structure of the DST. When the IRS put their stamp of approval on this structure about 2004 now, there were kind of a list of do's and don'ts, things you can do, things you can't do. And I'd say maybe more specific than just individual asset classes, what can and can't you do. There were a few rules, one of which has to be you've got to really buy stabilized, occupied, cash flowing type properties. So you can't really go out and do development or redevelopment. You can do a little bit of light value add, but you can't do a full heavy value add type of project. So typically middle of the fairway types of assets that you're buying, highly occupied from the get-go. I think, granted where we are in the economic cycle, again, you can buy more or less any type of asset class and put it into a DST. We just want to be very selective with the different types of assets that we're buying, really more so given the current market environment and direction we feel the economy is headed. Got
it. All right, so I realize that an investor can buy into a DST without the need to be in a 1031 exchange, right? You don't have to be in an exchange. And anybody off the street can invest in a DST. So let's start there. For a non-exchange real estate investor, can you walk us through how and why an investor would get involved with a DST? This is unlike the exchange investor.
Yeah, absolutely. By and large, again, kind of going back to just the passive side of real estate investing. Many individuals, and I think as we kind of look at just what's been happening in the marketplace and the stock market and equities and all the volatility we've been seeing, traditionally a lot of these assets might have a little bit less correlation to just the volatility in the marketplace itself. So I think the big benefit of the DST is you can invest literally as low as $25,000 and gain access to large institutional real estate. For instance, an Amazon distribution plant or maybe a Class A multifamily apartment complex where traditionally many people can't go out and buy a Amazon distribution plant on their own, but the DST gives them the ability to invest and own a fractional interest of that type of structure or real estate itself. So what individual investor has to do is these are considered securitized type of investment products. So you've got to go out and work with one of the sponsors out there, like an Inland, for instance, that has these DST types of offerings. Obviously, we work with a lot of individuals going through 1031 exchanges, but a lot of individuals as well that like the passive side of real estate investing, the check in the mail type of investment. Just a regular cash investment is suitable for this type of structure as well.
Okay, thank you, Brian. Brandon, let me ask you the same question, if I can, with a 1031 exchange investor, since I know that's your focus. How and why would that 1031 exchange investor get into a DST? And do they still need to identify a specific offering during their 45-day identification period, or just the DST sponsor, so to speak? Do the other Section 1031 IRS requirements also apply when using a DST as a replacement property?
Yeah, good question. I might pull Brian in kind of on the back half here, but we often see clients come in and they're looking for that tax deferral, right? The purpose of a tax deferred 1031 exchange. And they say, well, hey, maybe I've been getting a cap rate of 2% on my rental property in San Francisco, not so good, and they don't think they can do much better on a replacement. Or maybe they're just sick and tired, as Brian said, of what is it, the toilets trash Tucson? Sorry, I shouldn't trash Tucson, but the T's there. So they just want to get into something a little more passive. And what they do is they say, okay, well, I'm going to look at this DST offering. I'm going to work with a financial advisor, right, Brian? They have to go through an FA to get placed into these. And then from that point, they can say, okay, we're passive. We might have a higher cap rate than we had prior, or maybe a lower cap rate, but at least they're not having to be actively involved in it. And then as far as the identification goes, we do get a lot of people who come to us and they say, hey, can I just put Inland as the DST? Can I just list that? One day I'm going to maybe go into this, maybe another sponsor, something like that. But it can't be as simple as that. It has to be a bit more specific of an identification. So in most cases, groups like Inland, they'll put out a private placement memorandum, PPM. And then from there, they'll write down the exact DST that they're going into, as well as the percentage of that DST. And Brian, you could probably piggyback off that, but how do you guys help exchangers, clients go into these DSTs and I make that proper identification?
Yeah, absolutely. And the idea is really at any point in time, Inland might have 3, 4, 5 different DST offerings open and available for investment. So for instance, maybe we've got an industrial deal, multifamily, some self-storage, some student housing, what have you. So what an investor can do is more or less look at the menu of different DST offerings that we have open and available at any point in time. And they've got the ability to pick and choose or diversify across the board in a number of different types of investments. So as Brandon was saying, what we help investors do then is they get down to it. They say, hey, I'm going to identify this specific DST and maybe it's an industrial deal and maybe a multifamily offering. What we will do then is provide the physical property addresses for those industrial assets as well as the multifamily assets. We take their investment amount and we divide it then by the total size of the entire DST portfolio. So let's say they're investing $500,000 of equity, and we divide that then by the $200 million size Amazon distribution plant, and that spits out their fractional interest. So we certainly do need to be cognizant, number one, okay, how many properties are we identifying? Do we use the 3-property rule? There's also something else called the 200% rule, which typically when you're using a DST, you're usually going to use that 200% rule because more often than not, you're going to be identifying more than 3 properties by utilizing the structure of the DST. So what we do is a lot of that hand-holding where myself, Brandon, the investor, will walk through the process and really provide all of that information by day 45 so they have all that buttoned up.
Got it. So this is just a quick aside before we move on. You were talking about the 3 properties or the 200% rule. Can that be a combination of properties they're going to buy on their own and the DST? So somebody doesn't have to do all 3 DSTs, for example, or 200% DSTs. They can break it up between one or more DSTs and one or more properties that they would be buying on their own, correct?
They could, yeah. So we do see quite a bit of diversification there, where sometimes it's where they have maybe $2 million coming out of their sale and they're going to maybe place 1.5, the remainder they're going to put into a DST. And it could also go the opposite way, where maybe they just want to have something small that they're going to manage themselves, and then the remainder they're going to put into a DST as well. So there's a lot of diversification options with a DST on the identification.
So again, this is turning into an even better question because now we're talking about diversification. Most investors who don't invest in a TST in an exchange, most 1031 exchange investors, I should say, who don't go into a DST might buy an apartment building, one apartment building, or one strip center, or one single tenant net lease, what have you. And so all of their eggs are in one proverbial basket, so to speak. If they get into a DST, can they get some diversification by virtue of the fact that maybe that particular DST owns more than one asset? So their money isn't invested in one property, it's invested in multiple properties, maybe even multiple asset classes.
Yeah, I think that's the big benefit in my mind of the DST outside of just the passive structure itself is having that sheer diversification. Because you think about it, let's say somebody buys or somebody sells their commercial building in a specific submarket. Well, they've owned one asset in one city. Well, I can look at the different DST options that maybe an inland has out there, and I can take my $2-3 million sales price, and I can diversify then into 2, 3, 4 different DST offerings. So I could split that up and maybe put $500,000 in a storage deal, $500,000 in an industrial, some multifamily, and maybe some student housing exposure. And by doing so, I've just spread that risk across the board in the sense that I now own 4 different sectors of real estate. And more than likely, too, I've got some really good geographical diversification. Maybe all of a sudden I own properties in 4, 5, 6 different states as well. And in my mind, typically at that point, most of those DSTs might have a little bit of a different timeline before we're going to look to go out and market and sell. So you've also got then some money in motion every couple of years. You're just not waiting on one liquidity event. So yeah, absolutely, Neil. I think just having that sheer diversification is a great benefit to investors.
Perfect. Thank you. This next question is really for either one of you. Does it matter whether the investor has $500,000 coming out of their relinquished property or $5 million? And what if they also have to replace some debt? Let's just give an example. They have, $2 million in equity and $3 million in debt. And I just pull those numbers out of thin air. Can they still get into a DST where their equity is replaced and the debt is replaced, so they don't have forgiveness of debt or boot in any way? They have no real tax ramifications because all the equity was moved into the DST and they got a slice, I don't know if that's the term you use, a slice of debt sufficient to satisfy their debt requirement.
Yeah, so I'll take the first bit here. And that's, the IRS has 2 requirements for full tax deferral. And so we'll do those. And then I think Brian's going to have a really good answer for this debt component. Great answer, really. So essentially the IRS says, well, one, we got to reinvest the net equity, right? Everything that's coming out of that sale. So that $2 million in your example. Additionally, the second requirement is you have to acquire equal or greater debt on any replacement property or properties plural compared to what you paid off on your relinquished property. So they'd have to replace that $3 million as well. So essentially, in most cases, when we see someone doing a fully tax deferred exchange, they're maybe replacing with something of equal or greater value, oftentimes going up. You could do a partial exchange, right, where maybe you're not replacing with that full amount of debt and equity. You could maybe purchase something for $4 million. So then you're either taking home some cash, paying cash boot on it, or maybe you're not replacing all your debt. We call that mortgage boot. You pay tax on that as well as if it were cash.
Got it. Brian, did you have anything you wanted to add to that?
Yeah, just to kind of expand on that is the idea with the DST is some of our offerings might just be on an all cash basis. So inland goes out, we just write a check and we acquire the asset or the property outright. At other times, inland will line up some financing to go buy properties. So the example that I typically use, because I'm not good with math on the fly, is let's say I sell a property for $1 million and I have a $250,000 mortgage on it. So at close, I'm going to pay off my $250,000 mortgage. I've got $750,000 that goes over to Brandon at Asset Preservation, and the QI is holding on to that. Well, I've got to get back up to my $1 million sales price in order to avoid paying any debt. So I sold for $1 million. I paid off my $250,000 mortgage. I need to replace a 25% loan to value. How do I do that? Well, what investor can do is they can look at the different DST offerings that Inland has open at any point in time. And by diversifying into potentially a couple different funds, we can help them offset that level of debt. So maybe with my $750,000 of equity, I'm looking at an industrial deal that we have that's on an all cash basis. And let's say we've got another deal open. It's a multifamily deal that's levered at 50%. Well, if I take half of my equity and put in that deal with no debt, I put the other half into a deal that's levered at 50%, I've just blended to a 25% loan to value. So my 750 of equity at that 25% loan to value by going into those 2 different DSTs just replaced $1 million worth of real estate. You're using, in a sense, the debt that Inland lined up on our balance sheet to help you get back to that full sales price. To the investor, in my opinion, the financing of the debt is a great benefit. because it's all non-recourse, meaning Inland is the one that went out and secured the financing. The lender made the loan to us or the structure of the trust. So your worst case scenario, and unfortunately it hasn't played out this way, but let's say the deal or the investment blows up. Well, lenders, creditors can't go back to the investor. They go back to us as the sponsor or the structure of the trust itself, because they're not on the note. So especially, I think, given where interest rates are at today, instead of somebody having to go out and borrow at 5, 6, 7%, utilizing the balance sheet financing that we have might be a really good benefit to that investor.
Got it. Great stuff. I'm just curious, has any research ever been done to determine how much a typical investor gives up, so to speak, when reinvesting their sale proceeds into a DST, as opposed to continuing to buy a property that they own 100% manage themselves? So if an investor says, I'm going to make these things up, he's been used to getting 8% cash on cash returns, and he's going to invest in something managed by a third party, other than like a management company, property management company. Obviously they're not doing it for free; they have to get paid. So, are there any? I don't know. I'm sure there's no empirical studies or research necessarily, but if a potential 1031 investor says to you, well, I'm used to getting 8% and I'm only going to get 5% with you guys, or maybe it gets more. Does that ever come up in the conversations?
Yeah, it certainly does, and I think there's always a little bit of trade-off, and candidly too, I think it really depends on the type of asset that somebody might be selling. I was actually just speaking with somebody a little bit earlier this week, and their client owns farmland. Well, they're not cash flowing anything with farmland, so any sort of cash flow that the DST provides is going to be a benefit. On the other side of the coin, maybe somebody owns an asset, and like you said, they're roughly getting that 8% return. Where the market is sitting with most of the DSTs right now, low 3s to maybe mid to low 4s is a pretty typical cash flow. Now, where I sit down with a lot of potential investors, I just want to make sure they're thinking about it as kind of a net comparison, because typically what I find is somebody saying, hey, I'm getting that 8 or 9% return, but they're also forgetting about any mortgage payment that they might be making, their property taxes, any expenses that they have as they incur running and managing that asset. And at the end of the day, what is their time worth too? So, like I said, it is really all over the place. You may be typically giving up a little bit in the form of cash flow. But again, as we talked about, you're not getting that call on Christmas Eve or New Year's Day that there's issues with the property as well. So kind of having that check in the mail might be a benefit to people that just want to free up their time.
Not to mention, as a trade-off, which you've already discussed, they don't have to do anything. They might give up a little bit for that, but it's completely passive. They can go get on a cruise ship, for example, and go around the world and never even think about it. Somebody else is handling it for them. And, you got to give up something to get that peace of mind. So for either one of you...
Exactly.
So for either one of you, again, I know we talked about the fact that an investor can buy into more than one DST or into a DST that owns more than one asset. But I don't know if this has already been made clear. Are these DSTs already formed and up and running when they invest in it? Or is each, well, I can't imagine that you have a new offering going at every time somebody needs to buy in. So, or is an investor typically buying into an existing property that you already own, the DST already owns?
Yeah, and I think that's part of the uniqueness of the DST is, as we're going out, Inland will acquire the property or properties first on our own balance sheet. So we own 100% of that asset from day one. We then, as we buy the property, we then formulate the individual DST structure or trust itself, more or less syndicate the deal, as Brandon mentioned, put together that PPM or private placement memorandum, and then we start raising capital from investors. So the uniqueness is with any of the DSTs, before investor puts a penny of their own money into it, they know exactly what they're getting into. Because I think there is at times a little bit of confusion out there. People will use kind of a REIT structure and the DST as almost synonymous. Well, big difference between a REIT and a DST. Well, you really can't 1031 in and out of a REIT typically. But typically with a REIT, you're going to raise capital from investors first, and then you're going to go out and purchase assets or properties. Again, the benefit of the DST is we can literally go through and it's great reading material. It's about 300 pages long.
Wow.
But we can go through that private placement memorandum, where the assets are located, what the financing looks like, if there is any, what the pro forma cash projections and rent rolls and everything looks like. So there really is full transparency inside of the structure of the DST itself.
Okay, great. Thank you. So again, if you're just joining us, my guests today are Brandon Hughes with Asset Preservation, Inc. and Brian Lang with Inland Securities Corporation. And we've been speaking about Delaware Statutory Trusts, or DSTs. Gentlemen, could you just take maybe a minute of our listeners' time and share with them your contact information, an email address or a website and a phone number or toll-free number if you have one, just in case anyone listening wants to get a hold of you?
Yeah, sure thing. So I'll go first. Brandon Hughes, and our website, it's apiexchange.com, and that's API as an Asset Preservation, Inc. And my email, very easy. It's just brandon@apiexchange.com. Got it.
And you, Brian?
Yeah, and I'm Brian Lang with Inland Securities Corporation. My direct line, 303-916-0290. My email address is blang, so first initial B, last name Lang, blang@inland-securities.com. Inland's actually a relatively large corporation. All of our 1031 and DST structured products run through our private capital side of the business. So that website is inlandprivatecapital.com. If you want to look at the company as a whole, inland-investment.com.
Okay, great. Thank you. All right, moving on. This one's for both of you again. Per IRS rules and regs, can the investor in a DST be 100% passive once they buy in? I know we talked about this earlier. Or are there any ongoing obligations or requirements that they will need to meet in order to legally use a DST as a replacement property?
Yeah, so part of the DST requirements is that they have to be passive. It's not an option there. And Brian can probably expound upon that, but there were some rules put out a number of years ago detailing how the DST has to operate.
Yeah, I think maybe I mentioned a little bit earlier, the list of do's and don'ts that the IRS set forth when they put their stamp of approval on the structure. One of which is, going along the theme of being 100% passive, there's really never a circumstance or scenario where there can be any capital calls to the investor. Everything that we acquire has to be insured. Typically, we'll put business continuity insurance in place as well. And then we've got our rainy day fund or our cash reserves. Let's say we underinsured an asset. Let's say we didn't have enough in the form of cash reserves in place. Inland would have to dig into our own balance sheet to fix, repair an asset itself. So there's absolutely never that scenario where a storm comes through, roof gets blown off a property. We absolutely cannot pick up the phone and call our investors and say, hey, there's an assessment or we need another $25,000, $50,000 because X, Y, and Z took place. The design of this vehicle, being the DST, truly is that 100% passive structure.
And I guess sticking with this question just for a few seconds, because if I'm thinking of this, somebody else out there might be thinking of this. When an investor buys a property, forget about whether they're in an exchange or not, just an investor buys a property and they will oftentimes create a replacement, a reserve account. In an apartment building, it could be whatever, $300 a unit per year. In an office or retail property, it could be something else, maybe so much per foot. When Inland is raising money or offering a DST to the public, and they're buying in, is there a reserve account or a replacement of reserve account created with those funds so that there is a quote unquote rainy day fund if necessary, or is that not necessarily budgeted for and you just come up with the money as needed?
Yeah, good question. That really is part of our underwriting process as we go out and acquire the asset itself. is we are going to really figure out not only the cash reserves, how much do we need to kind of keep in that account from the get-go, but we also, as we look at acquiring the property, what are the expenses? Do we need to repair a few things? Does a sidewalk need to be replaced or a parking lot repaved? What do we need to do immediately, and what are the expenses to do that? But then over the course of the next 5, 7, 8 years, what are the expected expenses that we're going to incur during that period of time? So that really does play into, as we buy the asset, how much do we need to put aside or put in those cash reserves accounts for not only just day-to-day maintenance, but that rainy day fund as well. And if you kind of think about what that cash reserve account is, that is a portion of that is the investor's money too. So if everything plays out as expected, investors get that cash reserve back at the end of the day once the asset is sold. That's not something that goes into Inland's pocket, but that's kind of covering the what ifs along the way.
Okay, good. Got it. And I should have asked this question probably at the beginning, so my apologies. But does an investor need to be accredited to get into a DST, or if they have $2 million coming out of a property that they're selling, let's just say a lower amount, because if they have $2 million, maybe they are accredited. What if they have $750,000? There's no guarantee that they're accredited or not accredited, but they want to get into your DST. Do they have to sign something saying they're accredited, or does it not really matter because it's just the capital and Inland in this case is doing all the work anyway?
Sure, good question. Yeah, so really what the regulators look at these DSTs as securitized investment products. So by that definition alone, each individual investor does need to be accredited. What does accredited mean? It's either or. You can have $1 million of net worth, which can encompass everything that you own outside of your primary residence. So other real estate assets, checking, savings, pension, 401k, what have you. We can aggregate that to $1 million. If we don't hit that, you can also qualify on income. If you, over the last couple of years, if you're married filing jointly, if you've made $300,000 of income with the reasonable expectation you're going to make that in current year, or if you're single, the number's 200, that deems you as an accredited investor. Now, with this structure, Inland actually can't go out and market and put these types of investments direct in front of the public. There are certain types of financial professionals that really act as a conduit to be able to offer these investments inside of or to the individual investor at the end of the day. So as we go through the process of doing the education and getting comfortable with the structure of the DST, typically what I or even Brandon would do is we would introduce you to one of these financial advisors or planners that can basically help with the paperwork. Now, the onus of making sure each individual investor is accredited falls on the shoulders of the financial planner or advisor at that point in time. On our investor questionnaire and the purchase agreement, you're really just checking a box that says I'm accredited, but the job of that financial planner or advisor is to make sure this is a suitable type of investment for the individual investor, as well as making sure they hit that accreditation status.
Got it. And I'm just going to go out on a limb here and assume that most people investing in these or frankly finding themselves in a position to invest in one of these, meaning they're selling something else if they're in an exchange, I'm guessing the majority of them are going to be accredited anyway. There might be one or two along the way that aren't, but again, they can always buy their own property without having to go through this route. But I don't think that's going to happen. My gut tells me it's not going to happen that often. So we're getting down to our last few questions here. But let me ask, how long does a DST own the asset or assets? And once they sell, will the investor, so to speak, be kicked to the curb and have to go find another property? Or will they be invited back in to invest in another DST? So if it's an Inland DST and they sell in, let me just make up a time here, 7 years, now all these people are going to get their money back. They may not want their money back because they'll have a capital gains event. Do they have an option to roll right back into another DST within that same 180-day period, 80-day period, so that they don't find themselves with a taxable event?
Yeah, good question. And the idea is, I really want our investors to go into it with the mindset that commonly we're going to hold these things for about 5 to 7 years. So really an intermediate term hold is how I try to position this. Now, it certainly could be a little bit shorter. We've sold some of these DSTs in as little as 18 months, but that's because somebody comes to us and gives us a great offer. We absolutely have the ability to pull the trigger and get out of something a little bit sooner. On the other side of that coin, what could potentially cause it to be longer than 5 to 7? Well, to an extent, market conditions are going to dictate the right time to sell. Now, interestingly, one of the rules the IRS set forth when they put their stamp of approval on this was if we have financing on an asset, so if we use a little bit of debt to go buy something, we've got to sell before that financing or that loan comes due. We actually don't have the ability to refinance inside of this structure. So when we use debt, we'll use 10-year financing. That way I know, we're really not going to hold anything longer for 10 years. Obviously, we don't know exactly what the market's going to look like 10 years from today either. So typically we don't like waiting until year 8, 9, or 10 to sell, because what happens is you hit a recession in year 9, and then all of a sudden you're forced to sell at that inopportunistic time. So that's why very commonly 5 to 7 really is the sweet spot for this stuff. And Neil, to answer the second part of that question, yeah, the idea is in a very normal world, we want to give our investors maybe a 60, 90-day notice. Hey, we've agreed on the sales price. Ideally, here's your proportional interest and appreciation or gain at the sale. And then we ask the investors, what do you want us to do with the proceeds? In a sense, you're really back in the same boat as you were a couple of years back. Take your money and run and pay tax, or do another 1031 exchange. Now, you absolutely can roll those proceeds back into a different DST that we have open, or a couple different DSTs that we have open at that point in time. But there's also nothing that says you can't go out and buy something direct on your own again. So you actually do have a little bit of flexibility. So what we ask investors to do is we say, hey, if you're doing another 1031 exchange, give us the information for the qualified intermediary. So at that point, we send the proceeds back to asset preservation, and then they start the process over. 45 days to identify, 180 days to invest. But yeah, the idea is we're always going to have inventory available whenever these DSTs do sell, so investors have that ability to continue that tax deferral over and over and over again.
Got it. Understood. Brandon, speaking of asset preservation, can you speak to the investor's basis in the property they just sold and how exactly that would figure into the purchase of the DST?
Yeah, definitely. So it's very similar to if you're doing what we would maybe call a normal exchange, right? Where you're purchasing other real property, real estate. In an exchange, all you're doing is taking your basis from the relinquished property and you're moving it to become the basis in the replacement property. Now, of course, if you're adding additional capital on top of that, you might have a little higher basis, but that's what I tell people. I said, you're just moving it from one place to the next. If it's a property to property, you can look at it that way. If it's a property to DST, exactly the same thing.
So they're not making any improvements because, as we already talked about, Inland or the DST is going to handle all improvements going forward. So they're not going to be adding to their basis or making any changes to the basis by virtue of any CapEx or anything like that. Are they still getting depreciation inside a DST that they would get if they just bought, an apartment building, for example, on their own?
Yeah, a lot of the same benefits. At year end, we kick out, for all intents and purposes, it's a 1099. It's technically a substitute 1098, 1099 tax form. But what we do is we say, okay, here's your proportional or fractional ownership in the asset itself. Here are the expenses that Inland incurred running and managing the asset through that course of the year. With those numbers we put on the tax form, we then send that out to the investor. Investor typically will hand that over to the CPA. But what those figures, what the CPA then is able to do is continue to calculate depreciation. So we do have that ability to pass that depreciation through to investors. For those that still have depreciation that they can take, typically the first 3, 4, 5 years of most of these offerings, if not all, very close to 100% of the income is going to be tax sheltered through that pass-through depreciation.
Got it. Understood. Okay. Again, we're down to the last few questions. This one, again, could be for either one of you. For all the commercial real estate brokers who will be listening to this podcast and are currently working with a client to find a replacement property, can they earn any sort of a fee or commission by referring their clients to a DST, or will they essentially be, doing so just to ensure that the clients don't blow their exchanges and, keep some goodwill going forward with the client? And I guess the more I think about and read that question, it might be geared more towards inland than it is to Brandon and asset preservation.
Sure. And yeah, like you said, it's yes, it can be done. There's a couple different things that we have to do, and it's probably a little bit of a more lengthy conversation than we have time for today. But yes, in a sense, there are a handful of these financial advisors that do have the ability to, in a sense, kind of pay a referral or a finder's type of fee or structure. I will say, candidly, with a lot of the commercial brokers that I do work with, this is really a structure where I think it's good to just have in your back pocket too, in the sense that you can use the DST as almost a backup or fail-safe, listed as second or third through that identification process, just in the event that first acquisition falls through, and use it for the boot or the leftover money. Hey, we bought something directly. We've got $200,000, $300,000, $400,000 of leftover money. Don't pay tax if you don't need to. You can throw those leftover dollars into this structure. So I'd say by and large, with a lot of the commercial brokers that at least I work with day in and day out, they'll kind of utilize it to really just have a nice benefit to the client. But yes, potentially that there is, I guess, to answer your question long-windedly, Neil, there is potentially some opportunity to get that finder's or referral fee as well.
Okay, and thank you for that. So as we come to the end of our time together this morning, is there anything else that either one of you would like to add, either about your company, the service you provide, 1031 exchanges in general, or Delaware statutory trusts or DSTs?
Yeah, I'll go with that first. So as far as qualified intermediaries go, we're a small part of this, right? We're not going to be the 5-7 years like Inland is, where you're sitting with them and having to deal with them. We're just at max going to be someone you have to deal with for maybe a little less than 6 months. But a lot of people, what they're not aware of is qualified intermediaries, they're not, they don't have any rules governing how they hold their proceeds. So this is what I often talk about with people, different clients and exchangers that come to me. I say, hey, you could go out and maybe find one-man shop, something like that, but you really want to ask about the security. How are they holding your proceeds in that interim period? Where are they holding those proceeds? And are you sure you're going to get them back? And then also, when you're doing these transactions, as you can tell today, they can be complex. There's a lot of moving parts, a lot of people you have to work with. And it's good to have a QI who knows the ins and outs and who's done this a few times, so that we can direct you to the right tools or resources to get this done.
Thank you for that, Brandon. And Brian, how about you? Anything else you'd like to add that we may not have talked about today?
Yeah, absolutely. Maybe just a little background on Inland. Company was actually founded back in 1967 by 4 school teachers in Chicago. Fast forward to today and through this period of time now, Inland has actually owned and managed about $55 billion worth of real estate in the U.S. We're actually the 6th largest privately held owners of real estate in the United States. So certainly have had experience managing through a bunch of different and unique market cycles. We're not kind of the Johnny come lately on the block. Inland is the largest securitized 1031 sponsor in the business. So I think, it's been interesting the last few years. Real estate's done very well. We've seen a bunch of new sponsors enter this space, very few of which have had experience managing through a downturn in the market. And I think as we potentially see some storm clouds on the horizon, certainly anyone listening, just do education. Make sure that sponsor's been around the block and has had experience managing through thick and thin. And I'd say the majority of my day really is just doing that education. So again, anyone listening, always happy to just kind of talk about the structure, sit down with a client as well too, and just kind of walk through the pros and cons and features and benefits of not only what we do, but the structure of the DST as a whole.
Well, I can tell you both that as a commercial real estate broker for many years and having dealt with gosh, I don't know how many, lots, dozens of clients in 1031 exchanges. I'll admit this is something I haven't thought a lot about. I've successfully helped a lot of these clients with their exchanges, but there have been times where they just ran out of time. And now I'm thinking that if that ever happens again, I'm not going to let them run out of time. I'm going to be, in fact, long before they run out of time, I'm going to be talking about this because I really do think it's a great option and a great alternative, especially if the investor wants to be a little more passive. I think I've been taking some notes here. It's a great benefit to them to not have to go out and get that financing and sign on the dotted line, whether it's recourse or non-recourse. It's a lot of work. You're right. They could, as we said earlier, they could fly off to Europe or get on a cruise ship or, go play golf every day, whatever they want to do, and never ever think about this again, knowing that, a professional company that's been in business for, I lost track, is that 50-something years that they started this company? What a great alternative for people. And I'm sure a lot of our listeners out there, whether they're the investor or the broker, I think they're going to agree. So anyway, it's been a pleasure speaking with both of you. I've learned a lot. Like I said, I think a lot of people listening will learn a lot. I want to thank you again for joining us. And if you don't mind, maybe I can have you back again down the road to share any new updates, whether it be to 1031 exchanges or DSTs or anything to do with the commercial real estate market that you can share with us later.
Yeah, that'd be great. Thank you, Neil, for having us.
Well, thank you both. Have a great week. Take care. Bye-bye.